In June 2024, China's digital yuan recorded its 7 trillionth transaction. 7 trillion ECNY. That's $986 billion in a currency that didn't exist 5 years ago. Over 225 million Chinese citizens now hold digital wallets loaded with money issued directly by the People's Bank of China. Not printed, coded, every transaction tracked, every purchase recorded, every yuan spent leaves a permanent digital trail straight to the central bank, and they call it controlled anonymity. This is the financial historian, where money, power, and history collide. And nothing is ever as simple as it looks. China isn't alone. As of January 2026, 137 countries representing 98% of global GDP are exploring central bank digital currencies. 3 nations have fully launched them: the Bahamas, Jamaica, and Nigeria. 49 pilot programs are running worldwide. The European Central Bank is preparing the digital euro for possible launch in November 2025 or later. India's e-rupee circulation grew 334% in 1 year, and every single one of these systems has the same underlying architecture. The central bank can see everything. This isn't conspiracy theory, it's design. CBDCs are programmable money, money that can be turned on and off, money that expires if you don't spend it, money that refuses to buy certain goods, money that disappears if you break the wrong rule, and money that gives governments and central banks total visibility into every transaction you make: what you buy, where you go, who you pay, when you spend, all of it, forever. The end of financial privacy isn't coming, it's already here. And most people don't even know what they're about to lose. To understand why CBDCs are different from every other form of money, you need to go back to what cash actually is. Cash is anonymous. When you hand someone a $20 bill, that transaction leaves no record. No bank knows. No government tracks it. The bill passes from hand to hand, and nobody can trace where it came from or where it's going. That anonymity isn't a bug, it's a feature, a protection, a firewall between your private life and the state's surveillance apparatus. Digital payments change that. When you swipe a credit card, the bank records the transaction. But the bank isn't the government. The bank can see what you bought. But unless law enforcement gets a warrant, that information stays private. There's a legal barrier. A wall between your spending and state surveillance. Imperfect, but real. CBDCs eliminate that wall entirely because a CBDC isn't issued by a bank. It's issued by the central bank, the government's bank. When you spend digital dollars created by the Federal Reserve or digital yuan created by the People's Bank of China, the entity that issued the money sees the transaction in real time. No warrant needed, no legal process, no intermediary. The state is the bank, and the bank sees everything. China's system makes this explicit. The ECNY operates on what the People's Bank of China calls managed anonymity. Small transactions under 10,000 yuan, about $1,400, can be conducted with a mobile phone number and no identification. But every transaction is still recorded. And if the government wants to know who you are, they can trace the mobile number. Chinese telecom laws require carriers to register users with national ID numbers. The so-called anonymity is an illusion, a veneer over total surveillance, and it's not theoretical. In November 2025, the Wall Street Journal revealed that China and the military junta in Burma were using the ECNY to evade U.S. sanctions. The digital yuan gave Beijing visibility into every transaction made in Myanmar. Every payment, every transfer, every financial move by businesses, dissidents, and the pro-democracy movement. The CBDC wasn't just a currency, it was a surveillance tool embedded in an entire country's payment system. But China isn't the outlier, it's the pioneer. The model every other central bank is studying, because the technical architecture of CBDCs makes surveillance inevitable. Here's how it works. In a traditional banking system, money sits in private accounts managed by commercial banks. The central bank sets interest rates and prints currency, but it doesn't see individual transactions. It only sees aggregated data, totals, flows, not persons. In a CBDC system, Money is issued directly by the central bank. Every digital dollar or euro or yuan is a liability of the central bank itself. That means the central bank must maintain a ledger of who holds what. And every time you spend that money, the ledger updates. The transaction flows through infrastructure controlled or monitored by the state. Even in systems where commercial banks distribute the currency, the central bank retains ultimate visibility. It has to, because it issued the money, and it needs to know where that money is at all times. And this is the two-tier model that most Western CBDCs are planning. The central bank issues the currency to commercial banks. The banks distribute it to customers, but the central bank still controls the core infrastructure. The Federal Reserve's proposed design, the European Central Bank's digital euro, the Bank of England's digital pound. All follow this structure. All give the central bank access to transaction data. Officials insist there are privacy protections. That data will be encrypted, that access will be limited, that only financial institutions will see your purchases unless law enforcement gets a court order. But here's the problem. Those protections are policy, not architecture. They can be changed, updated, overridden in an emergency, during a crisis, when the government decides that national security demands it. The infrastructure allows total surveillance. Whether it's used today or tomorrow doesn't change the fact that it exists. And programmability makes it worse, because CBDCs aren't just trackable, they're controllable. Smart contracts can be embedded in the currency itself. Money that expires if you don't spend it by a certain date. China tested this during COVID-19. Digital yuan was distributed to citizens as stimulus with expiration dates built in. Spend it now or lose it. That's not money. That's a government mandate with a countdown timer. Money can also be restricted by category. Digital currency that can't be used to buy alcohol, or cigarettes, or fuel, or firearms, or anything the government decides is undesirable. The ECB has openly discussed using the digital euro to enforce carbon limits. A carbon budget embedded in your wallet. Spend too much on gas or flights and your currency stops working. This isn't speculation. It's been proposed in official European Central Bank working papers. And in a financial crisis, CBDCs give central banks the ability to implement negative interest rates directly on your savings. Right now, if a central bank sets rates below zero, you can withdraw cash and hold physical bills. With CBDCs, there is no cash. Your digital money sits in a wallet controlled by the central bank. And if they decide to charge you 2% per year for the privilege of holding their currency, they can deduct it automatically. You can't escape. You can't withdraw. You can't opt out. This is why CBDCs terrify anyone who understands monetary history, because money is supposed to be neutral, a tool, a medium of exchange that doesn't judge what you buy or punish you for saving it. But programmable, trackable, government-issued digital money isn't neutral. It's a policy instrument, a control mechanism, and once it's the only form of legal tender, resistance becomes impossible. That's exactly what's happening. In 2025, President Trump issued Executive Order 14,178 prohibiting U.S. agencies from creating, issuing, or promoting a retail CBDC. The United States became the only major economy to formally halt CBDC development. Florida passed a law banning state payments using CBDCs. Other states are considering similar legislation, not because CBDCs are inefficient, but because they're too efficient, too powerful, too dangerous in the hands of a government that might one day decide your spending habits are a problem. But opposition in the U.S. is the exception. Everywhere else, central banks are accelerating. The digital euro preparation phase began in November 2023. Rollout could begin as early as late 2025. India's e-rupee is expanding rapidly. Circulation jumped from 2.34 billion rupees in early 2024 to 10.16 billion rupees by March 2025. That's a 334% increase in 1 year. And the Reserve Bank of India is adding offline functionality, programmability, and broader distribution. The infrastructure is being built fast. Emerging markets are leading the charge, not because they're more authoritarian, because they have the most to gain. In Nigeria, the Naira launched in 2021 with the goal of improving financial inclusion. Millions of Nigerians don't have bank accounts. A CBDC gives them access to digital payments without needing a traditional bank. The same logic applies in Jamaica, the Bahamas, and dozens of pilot programs across Africa, Asia, and Latin America. CBDCs solve real problems. They expand access. They reduce costs. They modernize outdated payment systems. But they also centralize power. And that trade-off, access for autonomy, privacy for efficiency, is the defining choice of the 21st century. Because once CBDCs become the standard, opting out becomes illegal. Cash is already disappearing. In Sweden, only 9% of transactions use physical currency. In China, mobile payments dominate. Even in the United States, cash usage has declined by 30% since 2019. And as cash fades, CBDCs become the replacement. Not as an alternative, as the only option. That's when the architecture becomes inescapable. When there's no cash to withdraw, no physical bills to hoard, no way to transact outside the system. Every purchase you make flows through government-monitored infrastructure. Every dollar you save sits in a wallet the state can freeze, tax, or devalue at will. And if you protest, if you donate to the wrong cause or associate with the wrong people, your money stops working. This isn't hypothetical. In February 2022, Canada invoked the Emergencies Act to freeze the bank accounts of protesters involved in the Freedom Convoy. Over 200 accounts, no trial, no conviction, just administrative action. The government identified people supporting a cause it opposed and cut off their access to money. That was with traditional banks. Imagine the same scenario with CBDCs. No need to ask banks to freeze accounts. The central bank does it directly, instantly. And there's no cash alternative to fall back on. This is the future CBDCs make possible. A world where money is conditional, where spending requires permission, where privacy is a privilege granted by the state rather than a right protected by technology, and where dissent can be financially suffocated without a single arrest. Central banks insist this won't happen, that protections will be built in, that democracies won't abuse the power, but systems outlast intentions. Laws change, governments change, and once the infrastructure exists, it will be used, not necessarily by the people who built it, but by whoever comes after. The question isn't whether CBDCs will be deployed. They already are. The question is whether populations will accept them, whether convenience outweighs autonomy, whether financial inclusion justifies surveillance, and whether a world without cash is a world worth living in. Because once financial privacy dies, it doesn't come back. Once every transaction is recorded, monitored, and controlled, the freedom to spend, save, and transact without state oversight vanishes permanently. And that world where governments see every dollar you earn and decide how you're allowed to spend it isn't a dystopia. It's just a CBDC functioning exactly as designed. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.